Small cap index is higher, mid cap index is higher, so it's a pretty green looking screen out there. 25,800, we're already there. Next stop is 26,100. Those are the levels we put out in the morning. So let's see if the market consolidates around this one, around the 25,800, or it continues to march up. But it's a good gap up that we have on our hands. The CNBC-TV18 heat map gives you a quick sense on the Nifty 50 names, how we are starting. So you got Max Health and Bajaj Finserv on one end. Bajaj Finserv, Bajaj Finance were the two big losers yesterday. There's JSW Steel, which is in the other end, which is the loser. JSW Steel and Nestle in particular. So 117 points higher on the Nifty is what you have. Surabhi.
Yeah, absolutely. Recovery in the Bajaj twins. That's something to track this morning. Bajaj Finance as well as Finserv. Finserv also got smashed yesterday. Both of those stocks are up between 1 to 1.5%. Max Healthcare pushing a gain of 2%. Making it the best performing stock on the Nifty this morning. Reliance is batting quite nicely for the bulls. Reliance is up a little over 1%, 18 bucks higher on Reliance, so that one's quite steady. And the IT names, they have continued to chug along quietly so far this week. And in 3 days alone, some of the large cap IT names have put on between 2 to 4%. So quiet gains coming through for TCS, HCL Tech, Infosys once again this morning, taking their tally to about 2-3% for the week. Bharti Airtel is the other one that's on the upside. Eternal is up about 1.5%. On the downside, not too much. Apart from JSW Steel, maybe a little bit of red on Sun Pharma and HUL. But that's it. Nifty's quite steady with a gain of about 128 points, 25,800 plus. And this is where our technical experts were saying this is where the big fight between the bulls and bears will be. And we'll see over the next couple of hours who prevails. Nigel.
Well, that's right. Kirloskar Oil from the broader markets, that's a stock that's doing very, very well. I'm just looking at the revenues. That's up closer to 30%. The EBITDA margin as well, holding closer to around 20%. I think the street likes the big top line growth that we've seen on Kirloskar Oil. So that's clearly the stock of the morning on the upside. BSE already pointed out that stock has opened up a gap up. GSFC, that's another stock that's reacting positively. You have Belrise as well that came out with its set of numbers. I was reading a first cut, Jefferies first cut. They've been quite positive on the stock. They like the numbers. The stock is up closer to around 2%. And Zaggle as well. Management just joined us, sounding very optimistic. And the street is buying into that. What else is doing well? Ecos India Mobility, the stock is up 14%. Bazooka move is what we're seeing on this one. Big up move on this particular name. Parag Milk is another stock that's up 8.5%. So good move is what we're seeing out there. I think these are earnings reactions that we're seeing. And IOL Chemicals as well. The numbers look good, very good on a year-on-year basis. I recall having a look at those numbers. So that stock is well up closer around 10%. What's not doing too well? Orchid Pharma. That's selling off. That's down closer around 8% as we speak. So big negative reaction to the numbers. Orchid Pharma now down 8%. Let's pull that one up. PI Industries was down 3.5%. Numbers a little bit softish, but it's recovered a little bit from the lows that we saw a couple of minutes or so ago. Now it's down closer on 2%. And Landmark is another stock that's under pressure. Net, a good start, but you'll want to end with a solid gain because the gap up should not get sold into. We'll give you a sense in terms of the structure of the market as well.
No, just one more stock, Nigel, to add to your tally. Look at Syrma Go. Syrma is up 5-6% today. It was up in a big way yesterday as well after numbers. The numbers are very solid, 150 basis points margin expansion, some 37% top line growth. So it's really piling on the gains this morning as well. Prashant.
No, absolutely. And I think, Syrma continuing the gains. Just a bunch of other new names, right? So I think Max Financial we should pull up. So it's up about 3%. And I mean, the gains are okay, but volumes are very large. It's the third largest volume-led gainer on the NSE right now. Kirloskar Engine Oils is shooting up 12%, right? 1,057 on Kirloskar Oil Engines and on your screen now, about over 500,000 shares on the NSE now. There is Yatra, which is coming up with a 6.5% pop at this stage. So 176. Transformers and rectifiers, it's not the price, it's the volume. So 2 days, the stock crashed, I think, 20-25%. It's unchanged, but look at the volumes already on this one. So lots of back and forth activity there. 1%, 1 million shares on in terms of volumes on NSE. Something called I value. Did we mention this? 6% on this one, and it's only coming up on my screen because it's got volumes, huge volumes. 316 on I value. We'll try and look up the stock on this one. IOL Chemicals. I think we mentioned this. LTI Mindtree is up about 2.5%. EID Parry is up about 4%, and so it goes. So it's about 2:1 in favor of advances at this point in time. Hindustan Copper had a massive move yesterday on the upside, ended about 7% higher. It's the top volume-led loser. It's only giving back 3% of that big move yesterday, but it's got volumes. And you got Aether, which is down about 2.5% on the downside. MTAR Tech is down about 3%, had a big move yesterday. Thermax is down, Office is down 6%. And so it goes on the downside as well. So it's a good-looking screen overall. 100+ points on the Nifty is what you have. Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment. Rana, good to have you with us here. Thanks very much. I just want to start by asking you, this new listing today, Grow. I mean, I think it's a business which most people understand because most of our audiences would use some form of broking, if not Grow. So they're familiar with how the business works. And of course, I mean, capital markets as a theme is also has been on everyone's list as a secular kind of theme for many years. How would you think about a business like this, Rana, in terms of the valuations you would ask that you would give? So at the price that it came to the market cap it was asking for on F5 27 basis, I think Grow comes to you at about 25, 26 times earnings.
Sure. Thanks for having me. The way we look at the digital businesses, particularly the ones which has a very large TAM, like financial services, and if the company is vertically integrated on the back end and can offer a plethora of financial services, not just broking, they stand the opportunity to gain from cross-selling to the customers different kind of financial services, wealth management and commodity trading and whatnot, at a very low customer acquisition costs. So if one were to take a slightly longer term view, like 2 to 3 year view on these companies, I think their profits growth going to be quite strong and their valuations will perhaps be a little premium to the traditional, let's say, offline brokers and to also the premium to the brokers that are online and offline. Just a data point, you look at the largest listed online broker at the moment and look at the one that is listing today. Their top line is broadly the same, but the bottom line, there's a huge difference. I think that is the power of platform that one has to recognize.
Yeah, and we'll see how Grow does in its listed market journey, and we'll have the rates in just a bit from now. Rana, good to have you join in. What have you made of the Q2 earnings season? I mean, we started the year with expectations of at least 12-13% earnings growth. At the end of Q2, you think we're on track with those assumptions?
So we started the Q2 earning, as far as we are concerned, we started with about 10% earning growth for the year. And looks like, if I now factor in Q2, looks like pretty much we're on the track to deliver 10%. Having said that, I have to say that the earnings surprises has come from some of the financials, where the earnings were very good. Auto results were expected to be strong, but they have become even stronger. And from our side, what we feel is that domestic infrastructure companies, and by infrastructure, we define something like telecom, hospitals, hospitals, and all those things, they have also come quite good for us. So I think for the full year, we are quite confident that 10% will be delivered. The attention of shifts to FY27 and 28, where the projections is about 15%, whether that comes through or not. If in case it comes and our conviction on that is high, and we can talk about it why, then it will point inflection in earnings. If you zoom out and if you see FY25 and FY26, earning growth declined from 15-17% to more like 8-10%. Then if these earning estimates were to come through, it will inflect back to again from 8-10% to 15% in 27 and 28, which is something we are quite hopeful about.
Hi, Rana. Good to see you. Ben, I wanted to ask you about the space, the quick commerce space. There was a lot of enthusiasm, and these stocks did very, very well. Now, silently, these companies have gone ahead and they've given actually quite a large correction. If you look at Eternal, it's closer to 300 rather than 370 that we saw earlier, this month. Even Swiggy is way off the peaks that we have seen. Any view on this theme? They're getting money. When they go to raise money, they're getting money. Swiggy, for example, they're going to be raising 8-10,000 crores or thereabouts, in spite of having good amount of cash. What is your view? The runway seems to be big. There's a fear that intense competition comes in there. And when will profitability come? Your take.
Sure. First of all, let me just unequivocally say that we like the digital space.
Okay.
Because the digital space, this kind of connects the large customers with a good back-end supply. But having because the company is digital, that is not a guarantee to success. After you establish that, after we establish that we like digital companies, there are many key result areas that we need to monitor. For example, for quick commerce, the store productivity, the profitability of the older stores, the order value, how the company is pushing technology to the edge to tick those matrices up. On that count, the largest quick commerce company rates actually quite well. And this kind of fear that comes to the market that just because someone is putting $1 billion, they will be able to compete with their profits. I think they may have some merit, and that can affect 1 to 2 quarters. But for medium to longer term investors like us, it's we would like to see this as an opportunity.
By the way, we should tell our viewers that Tata Motors' CV business is going to be listing as a separate entity. Demerger is complete, and now when you have the option of playing the PV side or the CV side in different entities. And on that, Rana, where are you? Let's talk autos with the specific focus on CVs first. Over the last at least couple of months, numbers have started looking a little better. In fact, I think we're expecting Ashok Leyland to come out with a very good set of numbers again for the second quarter. So how do you look at a large entity like Tata Motors? And I mean, without getting into it's not a buy or sell question, but generally this demerged structure, would it perhaps offer more choice and unlock more value?
Again, we would not be able to talk on stock specific, but in this case, the merger that has happened, the passenger vehicle business still carries JLR. The Range Rover and all these things. I think for us sitting here in Singapore or for people sitting in India, it's very difficult to understand how a luxury car platform is going to perform. Especially, directionally, when they were at a lower utilization, one could have taken the direction call, but now that offered near utilization, incremental margins, at least we find it very difficult to call. So that being said, I think on the auto side, the commercial vehicle side was commercial vehicle was the other question. Commercial vehicle will typically depend on the industrial activity and the capex that we see. I think capex will continue, but we are not seeing that incremental delta will come through capex. So perhaps CV sales have bottomed out and they will, grow at a pretty, let's say a higher single-digit pace. But that's, I think, not very exciting as far as we are concerned. In the auto space, what we continue to like is the utility vehicle space, because the premium consumption, I think, was strong already, and with this tax cuts that has come in, I think it gets another boost. Although I understand that small cars and entry-level two-wheelers have done well for September and probably continue till December, our medium to longer-term view is the segments that were doing well, which are like bigger bikes and utility vehicles, will continue to remain stronger for longer. So that's the space that we like in the auto.
We leave it there. Thank you very much for joining us with that perspective. Always helpful, Rana, and good speaking with you. It's a busy morning both at the BSE and the NSE, and maybe we could just quickly show some visuals. So as Surabhi said, at the BSE, there is the Tata commercial vehicles business, which is going to be listed. We understand that the Tata Group chairman, N. Chandrasekaran, is going to be there as well. And
that's the Grow management.
Yeah, on the NSE, on the other side of the screen, you've got the Grow management, and we will, we will try and maybe we could just quickly listen in for 30 seconds and see what's happening at the NSE with Grow. Let's listen in.
Achieving its rightful place in the world of very fast changing technologies. As we ring this bell today, we do it with pride, humility, and optimism. Proud of what Grow has achieved, humbled by the trust we have earned, and optimistic about the opportunities ahead. Thank you all once again for joining us on this special day and sharing with us your joy. And now it's my pleasure to invite our co-founder and CEO Lalit to share more about Grow's journey so far, vision and road ahead. Thank you.
Gaurang Shah, chairman of Grow. Let's just stay with visuals. I think I think people would like to hear from Mr. Keshre, and we'll have him come up. Lalit Keshre, of course, has been the face of Grow, and we should sort of, cut across to it for maybe just 30 seconds or so, right? I mean, it's a capital market play. There you go. Let's just listen in.
I came to Mumbai in year 1999 with my grandfather. And this was the place where I came to know about, that somebody can invest in stocks. Like you can own a piece of the company. I was super fascinated by how you can own a piece of a company. And that's how the journey started. I opened my account. Of course, it was very complicated, very tough. It took me a lot of time to convince the bank manager to kind of open the account. But today, here we are in 2016 when Harsh, Neeraj and Ishan and I started discussing. Our idea was very simple. Can we make this process, can we make this process simple, transparent and delightful for customers? Can we make it on a mobile phone? And if we were also very sure that if people know that they can build wealth, they can grow their life and everything by by being aware about just simple thing that you can own a stock. This was like the realization. The second story is about the confidence of the new India. As part of our customer engagement, all of us visit across the countries, smaller cities across the countries. And then I was at one of those events, we call them Ab India Karega Invest. And I saw a father-daughter duo sitting in the audience. And the daughter, very young, almost half the age of the entire kind of room. And she was asking so sharp and so confident questions. And I got a chance to meet them after our kind of event, and I could see the sharpness in her and the confidence. But what was more important, what was more amazing was how her dad was.
Well, I think we will continue to hear out Lalit Keshre and other co-founders at Grow. So it was an incredible story. It started in 2016.
Yeah.
And 60,000 crores, I think, was the asking market cap valuation. I mean, that's how in this new age you can scale so rapidly, right?
And it all happened around COVID. I mean, 2019, the story really started picking up, 20 onwards. And I mean, they came as outsiders, challenged, disrupted a business that was being run by very well-entrenched, very well-established names. So that's the Grow story, and we'll have more on it in just a bit as well. And of course, more on the Tata Motors CV listing as well in a bit. But for the time being, let's turn our attention back to the UBS India Summit. And we have more voices now joining in. Sunil Tirumalai, Global Emerging Market Strategist at UBS, is with us. Sunil, great to have you on. Thanks so much for joining in. Interesting times, right? The summit is happening at a time where so many companies continue to list in India. They keep getting the money as well, at a time when a debate rages on the secondary market that, it's not attractive enough and not enough tech opportunities, so on and so forth. Let's start right there, because I think in your latest note, you are continuing to be underweight on India, and you prefer China and some of the other regional markets as well. So just juxtapose, to us, what is the reason behind your call, and how do you contrast the secondary market underperformance versus this absolutely exuberant primary market?
Thank you, and good morning to all your viewers as well. Yes, it's a very interesting time. So particularly for the India context, after a year of deep underperformance, the things which are changing are corporates, giving you any positive signals. That's something that we are really keen to understand over the next couple of days. I think coming to your question on our positioning and in our underweight position on India, there are a few, reasons behind it, right? If we actually look at the last 3-4 years of actual fundamental performance that we see, delivered by companies in India, the listed companies, the large companies in the index, you actually don't see any extraordinary growth or, either on top line or on earnings. It's pretty much in line, if not a tad lighter than the rest of emerging markets. The markets which are actually doing far superior are the tech markets like Taiwan, Korea, China too. And I think it also starts with the fact that the nominal GDP growth has actually come off significantly. And that matters a lot more for stocks, for top lines, for earnings, etc. Till let's say pre-COVID, or even till 2 or 3 years ago, India's nominal GDP growth was head and shoulders above other emerging market peers. But now it's not. There are other markets which are very within touching distance, right? So while that could stabilize and there could be some improvement, we don't see a catalyst that can take it back up to 12-13%, kind of, nominal GDP growth. In the absence of that, the valuations are actually, reasonably rich. So, in our numbers, historically, India used to trade at a 35-40% premium to other emerging markets. It's now, even after a year of underperformance, it's still at a 60% plus premium, right? Now, in the context of all this, I mean, the report that you're referring to that came out this morning, actually, we've done a lot of work on the AI theme itself. It's a global effort, trying to understand where we are in the cycle, how much, more to go at a global level, and which countries, which stocks are more exposed, etc. India is conspicuously absent, on that theme, and I think that's something that, from a global investor's perspective, other markets like China, like Taiwan, like the Korea, which are giving you better opportunities. Now, the specific question on, the secondary market versus the primary market, I think that's actually one of the reasons for the underperformance of the secondary market. So, if you actually see, no doubt the flows of household money into the stock markets is continuing. SIP investments, the flows are fairly high. They're not going much higher anymore. I mean, they're kind of showing signs of plateau. But the other interesting change is that the capital raise activity by corporates is actually shot up significantly. I mean, when we did some numbers pre-COVID, the total on a run rate basis, about 10% of the money coming in through SIP and mutual fund flows and other direct flows into the market from households, about 10% of it was the scale of corporate demand for equity capital. Now that number is touching 25%, and combine that with the fact that foreigners are also not excited. They are finding other markets to invest, and hence money being taken out of India. That's what is preventing the secondary market to do well. So you have a decent supply of paper. I mean, all these IPOs are good. They're really good headline material, but it also means that's money being taken away from the market.
Sunil, you're building a very believable, compelling bear case, justifying that call. So therefore, let me ask you, and we are barely, 3-4% at the index level, we're barely 3-4% away from the all-time highs. Given all the negatives that you described, the fact that MF flows have slowed down, there's no two ways about that, and FIIs have not returned, is there a possibility of some price correction in India? So far, it's largely been time correction. What do you see ahead for the broader market, for the index?
Okay. So let me take a step back. From a global perspective, we are reasonably positive on global equities, right? So, there's on S&P 500, there is a 10-11% upside till end of 2026. On our emerging markets target, it's a tad lower. So we are actually arguing for the US regaining leadership. The setup globally for equities is reasonably good. Global macro, on our economist numbers, US economy should start, revving back up and, accelerating in the back half of next year. China numbers, while they are slowing down, they have actually been upgraded from what it was a month ago for the next year. And in this context, where are valuations? And let's look at the rates market. There is an anticipation that potentially the Fed could start expanding their balance sheet. There will be stable coin demand in the US. I mean, all of that will keep yields in check. So it's a reasonably benign environment for global equities returns, right? So I think it will be really hard for more than a 5% correction, in the market. Of course, we need to be clear about a dollar correction versus a rupee correction. Our call is for the rupee to depreciate till end of next year. But keeping all of those things in mind, I think it's more likely that the time correction will continue rather than a very sharp price correction, because the supply of money from households is still continuing. That's a fantastic buffer, for the market. It makes it, very defensive and very protected against a big correction.
Okay, all right. Sunil, thank you very much for joining us, and Good speaking with you here on CNBC TV18. I think, 90 points higher on the Nifty, 25,785 is looking super strong. 2:1 is the advances to decline ratio, 1,800 up and about 800 lower. So still looking very, very strong. And by the way, BSE is moved up 6%, by far the number one volume-led gainer on the NSE. Nigel.
All right. Well, let's focus on Fortis Healthcare. They reported a good set. Double-digit growth continues with margin expansion. We have with us Mr. Ashutosh Raghuvanshi, the MD and CEO at Fortis Healthcare, who joins us on the show. Hi, sir. Good morning and good to see you. Ben, give us a few details. What's the outlook with regard to occupancies as well as the average revenue per bed? And tell us a little bit about how the case mix evolved in the past quarter.
Good morning. Glad to be here. The outlook is, as far as occupancy is concerned, we have had a good occupancy on an enhanced base of beds. We increased about 550 operational beds. On that, we had about 70% occupancy. On the organic basis, it was almost about 80%. So that trend likely to continue. However, third quarter typically is a quarter which has less occupancy because of festivals and holidays, etc. So we would probably see some dip in third quarter, but that should recover in the fourth quarter. As far as the case mix is concerned, we are continuously seeing a trend of more complex cases coming, as well as the surgical cases being higher in number. And that is what is driving the ARPOBs higher. However, if you see from the last quarter to this quarter, our ARPOB has more or less remained stable. It has not grown in the same proportion as earlier. And that's what I have been saying for some time, that these ARPOBs will get moderated. But the increase in ARPOB is exclusively a function of case mix and not a pricing change. So that's the trend which is going to continue in future as well. And we are pretty confident that the occupancy levels would remain high.
Okay. All right. Just to focus on the hospital business then, give and take everything that you said, for the year, we should be looking at what? Mid-teens growth, in the hospitals business with margin expansion of 100, 200 basis points. Gettable?
Yes, so we saw about 19% growth in this quarter in the hospital segment alone. And we expect that this trend would remain. So definitely mid-teens or high teens, I would rather say.
Okay. Fill us in with the current status with the insurance companies. The company, there was that dispute with regard to cashless payments. Has that been resolved? Where are we at with regard to that?
Yeah, so cashless issue was not with us, but it was there across the industry. And that is, for now, it is resolved. Having said that, insurance, health insurance is a very, very important component of the healthcare ecosystem. Payer is as important as provider. And we expect that, the relationship between the two would improve. So a lot of dialogue is happening, a lot of engagement is happening with the insurance. And I think there are certain reforms which need to be done. And we are moving in that direction. So one of the demands which the insurance companies have is to get onto the healthcare exchange and have a kind of a...
Can I... Right. Can I just a specific question, sir? We reported this. Good morning, Prashant here, Mr. Raghuvanshi. And of course, this is with help from, of course, government as well. After discussions, that major hospital chains have agreed not to take price increases for 2026. Can you confirm that for us? If that has happened?
I don't think there is any such proposal. At least we haven't heard of any such proposal. But as I have been saying, that the price hike in the hospital segment has only been to the tune of about 1.5% year on year. So even if this year, whatever price hikes happen, is likely to be in that range only. As far as Fortis is concerned, we haven't taken a price hike this year. But early next year, we would evaluate whether a price hike is required.
So you're saying that there is no... Okay, so you're free to do what you want. You've not taken one this year. Next year, it's possible. But as this gets under more and more, and there is a fair bit of angst around this, right? Both on the insurer side and hospital side, and depends on who you speak to, and you get both views. But this is the issue which is going to come up, the cost of healthcare, right? And who's paying for it is getting more and more scrutiny, and I suspect that will only increase. Mr. Raghuvanshi, what is your own sense, sir? From a hospital perspective, do you expect this to get more look in from the ministry, government, etc. as well? In that sense, making it a little more harder for hospitals. Because I'm speaking to you, of course, some things may happen on the insurer side as well. But for now, if we were to talk about hospitals, price increases to get tougher.
Yeah, Prashant, I have always maintained that price hike is not a lever which the hospitals should be using, and that is our preference not to use that lever. And as I was saying earlier, the insurance providers and the healthcare providers, both the payer and provider, are equally important parts of the healthcare ecosystem. And it's our responsibility to resolve these issues and make sure that the patient gets the best possible deal. So I think the effort is in that direction, and you are absolutely right. The government also is very proactive in this area. A lot of dialogues are happening as we speak, and we expect that these issues will be resolved not overnight, but over the next 1-2 years. You should see a lot of reforms happening in the payer-provider ecosystem.
Okay. All right, sir. Appreciate you joining in. Thanks a lot for giving us that insight. Wishing you all the best. And we look forward to speaking to you as the quarter progresses. For the time being, we slip into a short break. We'll speak with the management of Bharat Forge. Mr. Baba Kalyani is waiting for us on the other side. They reported a strong set of numbers.
Welcome back. Grow is settling at 112 rupees compared to an issue price of 100. Tata Motors CV, the price is settling at about 335. This is in the pre-open. The listing happens at 10 o'clock. So, interesting with both those. And we'll, of course, go across to NSE and BSE. As I said, it's a busy morning at both exchanges with these respective listings. Bharat Forge is the next business and company that we want to speak with. They reported a healthy set. Baba Kalyani is Chairman and Managing Director at Bharat Forge is with us now. Mr. Kalyani, good morning. Great to have you with us here. It's always a pleasure speaking with you. Prashant this side, sir. So the standalone business was impacted by sharp declines in North American truck production and, of course, the resulting inventory destocking. And of course, I mean, some of the other non-truck businesses made up for it. And I guess that is the guidance going forward as well. But can I get a sense, some guidance from you on the truck business side, sir, for calendar 2026 from you?
You know, the truck market in the U.S., if you look at the medium and heavy trucks, that's down by almost 45 to 50%. And it's not just the 50% drop or 45% drop, but because of that, we have to also destock. So our supply is actually at about 30%. So when this gets to normal, and I hope this will get to normal once the tariff situations get to normalcy, not only with India, but with other countries, and that's probably like to happen by next quarter. So we see calendar year 26, second half, things to improve in this sector.
The OEM guidance for 26, companies like Volvo, etc., they're all forecasting some decline, right? At this point.
It is forecasting decline because they also have the problem of destocking. I mean, everybody was building at the rate of 350,000 trucks. So almost 27,000 trucks per month, and now they have come down to 14,000 trucks per month. So there is a hell of a lot of inventory, supply chain inventory, and all kinds of things. On top of that, they have to pay very high tariffs on most of their supplies. So it's a little complicated problem, I think, but looks like the problem is going to get solved, hopefully in the next few months. So we should see unwinding of this probably by second half of 26.
H2 of next year. What about the non-auto business, sir? Could you provide us, and we'll talk specific numbers there, but you think growth there continues?
Yeah, the growth there will continue because that's a strategy that we have put into place, that to grow our non-automotive business in multiple directions. And there are huge opportunities today coming up in that area. And there are high technology products, and we are good at that. That's something that kind of fits our profile. I can't say more than that because most of these products are pretty sensitive in terms of information sharing. But we see a large growth coming in the industrial products. One of the areas where we are seeing a massive growth is the high horsepower engines. Of power supply, power generation, standby supply to all the data centers.
Oh, okay. Of course. Yeah, that's a budding industry. Lots of action on the data center front. Sir, got that. If I may ask you, sir, I know a lot of these businesses will build up over the coming several quarters. But if I could ask you for a ballpark understanding of how Bharat Forge consolidated will look like, say, by the end of next year, end of FY27, in terms of total revenue, how much is going to be automotive? Within that, how much India, how much overseas, and how much will come from these newer businesses, whether it's defense and there is aerospace, and now like you're talking about data centers, which is, industrials X of auto.
I can't tell you exact numbers. All I can tell you is that, there are certain events that need to take place before we start seeing growth. One is the trade deal that needs to happen. And second is, in the U.S., the industrial and commercial vehicle production has to get back to normal. I'm not even saying it needs to increase. It just needs to get back to normal. These are, I think, two conditions that need to happen. As far as Bharat Forge is concerned, we have kind of taken a lot of steps to isolate us from that, and that's why even in the quarter that just went by, our consolidated data looked much better than this. We have one sector that is growing at a very fast pace, and that is our aerospace sector. We see our aerospace sector going at almost 25-30% annually for the next couple of years. So that's a very good thing for us because we have worked hard on it for the last few years. We have invested in it, and now we are beginning to see the results. And it's a very profitable sector.
All right. Hi, Mr. Kalyani. Good morning and good to see you, Ben. So let's touch upon a little bit about the aerospace business. As you said, you're expecting a big growth. I think at the end of this year, you're expecting it to be a 350 crore business in terms of revenues. Say in the next 2-3 years, how big can this business become? And also in the defense business, you've done a fantastic job. The order book is at around 10,000 crores. However, execution has been a little bit slow in the first half of the year. I think you're expecting the second half of the year to be much better. So what is the revenue trajectory on the defense business that last year did around 1,700 crores? How do you see this business scaling up for this year and post that?
This business execution hasn't been poor. You know, it's just the process that is laid down by the Defense Ministry and the Armed Forces. It just takes a long time. I mean, there's something called FOPM and all kinds of things involved. So once that process is finished, from our side, execution will be extremely fast. Like you saw when we got the order from Armenia for artillery guns, we finished the order 1 year in advance. So execution is not the problem. I think the process is a little complicated process, but I think hopefully by next quarter, that process will get over and then we will start delivering guns to the Indian Army.
So by the end of this year, defense will look like what kind of revenues? I think earlier we were guiding for close to 2,000 crores of revenues. Will that be possible? Second half of the year can make up so much?
No. It will be similar to what we have today.
Okay.
Maybe some small increases because we are now getting, we just got an order for underwater systems, which we have to deliver. But all that it has to be delivered in the next 12 months.
Okay. Let's take a longer term view then, sir. In the next 2 years, what is the revenue outlook for the defense business where you're sitting on a super order book and on the aerospace business, which is growing at a very fast pace?
A lot of growth 2 years from now in the defense because it's not just one vertical of artillery guns or something like that, or we have a large order on small arms, but we have created 3 or 4 new verticals in unmanned systems, underwater systems. We now got an order for an underwater system that goes down to a depth of 1,000 meters. That's a technology which hardly anybody has in this country.
Yeah.
And similarly, we are targeting some unmanned systems in the drone, sophisticated drone area, kamikaze drones and others. We will know about it in the next few weeks. But there's a lot of work going on in our company on that.
A lot more questions, Mr. Kalyani. Just one last. In aerospace, do you supply directly to the two players, or you supply? You supply to supplies with intern supply to the two Airbus and Boeing?
No. We have 2 sectors in aerospace.
Defense and
jet engine manufacturers. So we supply to Rolls-Royce. We supply to Pratt & Whitney.
Okay.
And we supply to Honeywell. These are 3. The only jet engine manufacturer we have not yet got orders from is Safran.
Okay.
All the engine manufacturers, we supply them rotating components, turbine blades, active components that are in the engine and the turbine.
Okay. Very quickly.
Titanium, high temperature alloys and all that. So pretty high technology.
All right.
We supply structural components to Boeing, structural components to Airbus through one of their tier 1 suppliers called Liebherr, where we supply landing gear components. To Boeing, we supply large components which connect the engine to the wings, a large titanium forging. So there's a variety of products that we do, and that business is just growing.
Very quickly, sir, some inorganic growth is planned. Have you got a fixed target? Because you're raising some money, I think 2,000 crores for both organic and inorganic. But should we expect some kind of inorganic growth?
Our overall strategy is to pivot our business to the India-centric business because we believe that India is going to be the largest growing market for the next 15, 20 years. If you look at Honorable Prime Minister's Viksit Bharat program, whatever the numbers come out, whether it's 25 trillion, 30 trillion, whatever it is, the growth in India is just going to be fantastic.
Okay.
And focusing largely creating a focus and tilt towards Indian growth. And that's where some of the M&As, inorganic activities will happen.
Okay. All right. Sir, thank you very much for giving us perspective on all of your businesses. And we wish you good luck with the second half. In the next couple of seconds, Grow will start its journey in the public listed markets. The prices settled at around 112 in the pre-listing session, which is actually a little better than the so-called great market premium. And I think we have the entire top team there ringing the bell.
Some kiddos as well.
Look at the little babies. They love it. They love it. You know, this.
Yeah.
117 rupees now, 70,000 plus crore in terms of market capitalization. So that is the picture at this point in time. I mean, 118 rupees, and it's a good listing. 112 was the listing price, and it's moved up from there. Tata Motors commercial vehicle business listing at 335 rupees per share at this stage. So Grow is, I think, 20% now.
Yeah.
And a lot of demand, a lot of interest. It's a business which people understand, and many, of course, use it as well. 30% higher on the Tata Motors CV business at this point.
I think if you just get those visuals back up, something Surbhi was talking about earlier, diametrically opposite, in terms of those visuals that are coming in.
Two different companies, two different businesses, right? You have
two different businesses, the suit and boot.
The suits and ties on the left, and then, the usual jackets or the jumpsuits maybe on the right. One, a new age entity, a disruptor, completely redefined the way broking, and especially discount broking, how it took off in the country, becoming the biggest broking entity with the largest number of active clients on the NSE. And of course, on the left, Tata Motors in its new avatar, now with both the businesses separate, PV and CV, looking to inspire more confidence. But yeah, Nigel, absolutely. That's what I was noticing earlier as well, right? You have the suit and ties on one side, and then you have the new disruptors on the other.
Well, and the babies always steal my heart. Beautiful visuals coming in there. I think the little champion got too close to the bell when it went off, and then he was all surprised. But that's about that. We take a break, I think, sir. Come back, and we'll be joined by the management of RITES. Stay tuned. Welcome back. Let's get straight to rights. They report a good set of numbers in the second quarter. In fact, the management is confident of surpassing their FY25 revenue growth going forward as well. We're joined by Mr. Rahul Mittal, the Chairman and Managing Director of the company. Hi, sir. Good morning. Thanks a lot for speaking to us here on CNBC-TV18. Fill us in with the basic numbers. What kind of a revenue growth are you looking at? Last you were talking about, surpassing FY25 numbers. So on that sort of a base, what kind of growth? One, EBITDA margins as well as profitability margins.
Good morning. Yes, when we spoke last, we had said that our aim is to sequentially keep on improving and surpass the last year's figures, both in top and bottom line. And as you see the Q2 results, we are moving in that direction. There's been about a 12% growth sequentially. YOY, in any case, there has been a substantial growth in the bottom line. And also the margins have been able to, we've been able to not only secure them, but, substantially above the range that we had set. So we are moving in the right direction and we are satisfied. We're quite happy, in fact, with this quarter in the sense that whatever roadmap we had set at the beginning of the FY, we are moving in line with that. So EBITDA margins of above 20%, PAT margins of above 15% minimum, and definitely a growth in the top and bottom line vis-a-vis last year.
Mr. Mittal, your order book is now closing in on the 10,000 crore rupee mark, right? So just tell us how the split is between turnkey and the other segments, and also which segment is going to be driving growth. How it's shaping up, and particularly your big India business on the domestic consultancy side. What is happening out there?
Yes, so the order book has been substantially growing. We've crossed the 9,000 crore in this quarter. We added 150 plus orders totaling to about 850 crores plus. So a net addition of about 300 crores in this quarter. And the turnkey segment is 4,300 crores. The consultancy is about 2930 crores. The export of rolling stock is about 1540 crores and the balance is about 300 odd crores. So if you see the key drivers in terms of top line, the top line will be driven by the execution of the turnkey projects, but definitely the margins in turnkey are very low. The bottom line and the margins will be driven by my consultancy and the export of rolling stock. And that is what, if you see, has contributed to the Q2 performance also. It's primarily because of the contribution by the consultancy and the export of rolling stock segment.
So your EBITDA margin moved up to, I think, about almost 23.5% in Q2. Are these, sustainable margin levels? Because I think your guidance for the full year is around 20%, but because Q2 has been so strong, how is the mix going to be? And then could the overall full year margin be better than 20%?
So you see Q2, because the contribution from the turnkey segment was very low. If you see, there's a 90 crore dip vis-a-vis YOY. And that's primarily because in the turnkey segment, more than 2/3 of my order book is less than about a year old. It's about 8 to 10 months old. And the actual execution and the revenue booking will start in Q3, Q4. So definitely the blended margins will, kind of contract and be in the range of about 21 odd percent. This quarter, the contribution was majorly from the export and the consultancy wing. About 90 crores of the dip in turnkey was offset by 90 crores by the consultancy and export segment. So that's why the margin, if you see in this quarter, has been slightly higher. But to my mind, on an annual basis, we'll settle in the range of about 20-21% EBITDA margins.
20 to 21%. Is there an increase in competitive bidding in domestically? And also just give us some color on exports. Obviously, is a very small part of your business right now, but you are looking to grow it. So just leave us with some, maybe some aspirational targets and what you're thinking in terms of exports going forward.
So you see, we had set ourselves a target of getting one export order a quarter last year. We started this about 7 quarters back. and we've maintained that steadily. Even in this quarter, we got an order for 160 crores for export of rolling stock. And now our export order book stands at 1540 crores. And this is the first quarter that the delivery started. So you see, after a long gap of nearly about 5 to 6 quarters, you see a booking of about 60 crores on the export of rolling stock. And this is the segment which is going to drive in the coming quarters. We are confident that we will continue to maintain a trend of getting at least one export order a quarter and parallelly delivery on the existing order book.
Okay. All right. We'll leave it on that note. Thank you very much for joining in and giving us some perspective on the numbers. Thanks for being there. Well, we'll take a quick break. On the other side, our special segment, It's the Economy. Today, Lata is in conversation with Santanu Chakrabarti of BNP Paribas on his stock picks after the BFSI Q2 result period.
We keep it with corporates. When the banking and NBFC result season started, the fear was there will be deep margin and hence profit cuts. But actually, the banking results season started with a bang, with the likes of ICICI and HDFC Bank barely showing any fall in margins, 4 and 6 basis points. SBI actually showed an increase in margins. But the end of the BFSI season was a bit of a dampener, with Bajaj Finance reporting, the king of NBFCs actually, showing a rise in NPAs and a rise in credit cost and lowering its loan growth target to 22 to 23% from the earlier target of 24-25%. So what's the final takeaway from the BFSI PAC Q2 results? I have with me Shantanu Chakrabarti of BNP Paribas to take us through his picks. Good morning, Shantanu. Thank you very much indeed for joining us. Let me start with the last. Bajaj Finance, which has thrown a bit of cold water on actually all the BFSI stocks. The stock was down 7% on the day after the results. It is still your best pick, you say. Aren't you worried that their MSME loans are showing so much of red?
Morning, Lata. Great to be talking to you again. So yes, Bajaj Finance coming and out and guiding for a full year loan growth of about 22 to 23% was the clearest dampener out there, because all the credit stuff that you're talking about in terms of either credit costs or rise in GNPAs, while yes, there has been some worsening that they reported, the guidance range was moved by a very small amount. So what was earlier described as a 185 to 190 corridor was now made into a slightly wider 185 to 195 corridor. Now that, I mean, to ascribe a large price move to that level of precision will probably be spurious. So it is fair to say, probably in our opinion, that it is the disappointment around the full year growth, which you rightly point out is linked more to the SME segment, which they are saying is going to grow only 10 to 12% for the full year, is what led to the disappointment. Now, Lata, to be very clear, Bajaj Finance is our top pick within the NBFC space. But you remember this very vividly. I have had at one point of time, close to 60% kind of upside on the stock. But the stock has had a very sharp re-rating. So, in such a situation, even a small near-term disappointment tends to take a little of a stock price and probably given another opportunity for a set of long-term investors to come into this. Because when I step back from the disappointment of a slightly more muted overall growth in the next 2 quarters, what stands out for me is that they have not changed anything regarding their long-term guidance. And if anything, a lower base in the second half of 26 probably sets them up to put out a significantly more aggressive FY27 guidance than they would have otherwise. And finally, I mean, you have to see that, the SME problem which they had been talking about, their specific segment, the other bits, including rural, has now picked up very sharply. And they, of course, like most other companies, they have spoken of a fairly strong October, and they're building into that strength. So from that point of view, I see the current dip as a very clear opportunity. Having said that, obviously, I prefer my banking picks in terms of upside a lot more. Bajaj Finance, despite the 7% correction, is in essence now still a compounding story, not the sharp re-rating story it was, say, a year back.
Fair point. For Bajaj Finance, the quarrel really is, it is still what now, 5.7 times book. So, the worry is it overpriced? But I'm asking you to take 2 other takeaways from the Bajaj Finance results. We are talking about an A1 company, a AAA company. And that company is telling us that they have problems with MSME and problems with SME. Now, where did all the banks show their increase? Take Axis Bank. It was their MSME, their business segment, which they said grew best at about some 16%. ICICI grew that segment by 29%. HDFC Bank grew that segment by 16%. They're all A1 banks. But would you worry that MSME may be the next fall? That if Bajaj Finance has faltered, won't you see it in the other banks when, the reckoning comes next year or something?
Right. So I think the first buyer beware I would like to start with is MSME is a very dangerous jargon in the Indian financial services context, because it can mean a lot of things. It can mean a age.
Defined differently.
Yes, it's 80 lakh rupees or 70 lakh rupees for a Bajaj Finance top-end customer, while it may be 750 crores for a bank customer. So we have to be really careful in parsing through what each of these definitions mean. Having said that, I think, we even within the unsecured working capital loan business, which a lot of the NBFCs did, which was essentially a top-up on an existing term loan for a fully banked customer. And, some of the larger ticket LAP-aligned segments have been showing some stress for 6 to 9 months. Now, the reason you don't see too much worry around that within, say, a HDFC or an ICICI, or for that matter, even an Axis, is merely because in the context of their particular balance sheets, that's not a very large amount. And what they call, SME, even within their retail fold, probably has slightly higher ticket sizes. So we just need to parse it a little bit.
Fair enough. Okay, let me hope that, we went through a big infra loan cycle in the 10 years ago, and then we went through MFI cycle, and then we went through unsecured loan cycle. I'm just worrying that it should not be an MSME cycle next. Thank you for allaying my fears. Now, just tell me, what's your pick of the pack in the NBFC space other than Bajaj Finance?
So, so we also like FedFina, but again, a lot of the re-rating has already happened there. We are neutral on something like an HDB because we think it's a decent compounding story, but a lot of the valuation is already there. And we have, our top reduce, if you will, or underperform is essentially SBI Cards, which was probably delivered the fifth or sixth disappointment in sequence, and still stock has probably not corrected as much.
Okay. Now let me come to the banks, which you say is your far bigger favorite. You've upgraded Axis. Take us through that, because there was a disappointment with the asset quality numbers when they came.
Right. But all things considered, if I look at the last 6 to 7 quarters, I think the market's next day reaction also proves it. This is perhaps the best set of numbers vis-a-vis expectations that Axis has delivered in the last 6-7 quarters. Because every time Axis has delivered a set of numbers in the last 6 to 7 quarters, bar one, I think, the stock had corrected fairly sharply. So what positives do we see in Axis? Firstly, credit costs continue to remain elevated above what, say, their, if you define HDFC or ICICI as the peer set, then credit costs are significantly higher. And given, where even PSU bank credit costs currently are, or the slippage rates are currently going at, Axis looks a little higher than it should, given the quality of the franchise that we are talking about.
Okay.
But after a long time, there was better than expected performance on growth, profitability, operating economies, and such. And I think even today, what we have done is we have upgraded the targeted multiple from 1.7 to 1.9. Okay. Frankly, if this is a 15-16% ROE bank, it could command potentially mid-twos. So I have only unlocked a little bit of its full potential, given that there is some green shoots within the overall operating and ROE framework that they have been delivering.
Okay. What's your finally? What's your expected earnings growth for the banking space for the current year and for next? Overall, Nifty earnings is not very impressive. Will BFSI earnings be much better?
So if I look at full year earnings, the growth is going to be low single digits in our expectation. So that's nothing to write home about. But please understand that, the fourth quarter of the previous financial and the first quarter of this financial was kind of the bottom of earnings growth.
Okay.
So if you start looking at the earnings growth, which the quarters or for the second half that is going to come in, I think by the time you exit the full financial year FY26, you'll be seeing double-digit earnings growth.
Okay. That means next year we should be expecting, close to 20% earnings growth from...
Potentially, if next year credit growth is also strong, what we could certainly say is that on a full year margin, just that delta between 26 and 27 can contribute 500 to 600 basis points of earnings growth.
Okay.
Plus whatever you do on loans.
Okay. Well, I will have to invite you for a bigger discussion on another day. Thank you very much indeed for joining us. With your quick take, we had two big listings today, and that took away time, and we couldn't hear our commodities expert, Manisha. Manisha, sorry for that delay, but what do you have for us today?
Thank you for that, Lata. Well, I'm talking about the aluminum prices because while they have been in flavor and the markets do believe that we would be looking at deficit and price increase going forward, but what the markets are dealing with immediate concern really is the premium in the US consumer market, where the physical market is trading at a record highs right now. So from where we were in the month of January to where we are trading right now, it's a 155% of an increase in prices for the US consumers of aluminum who are making various aluminum products there. So this is on the back of import tax. tariffs, of course, and the tight supplies that we are dealing with in the global markets. So when you look at the calculation overall, remember, US has put 50% of tariff on aluminum imports starting 4th of June, and that clearly has disrupted the market. So US prices basically take LME prices as a base, and then they add premium to that. So when you look at the LME prices for aluminum, that is trading at $28.50 right now. The premium that US markets are commanding right now is $19.40 a ton, and that brings the US consumer paying $47.90 a ton for aluminum prices, while the rest of the world, or LME, is paying just about $28.50, which, by the way, also is at a 3-year highs. So we are looking at the US consumer inflation clearly coming in for aluminum products in the higher markets therein. So you are looking at LME prices trading at a 3-year highs. We've seen prices gain up by 13% in 2025 till time, and there have been various reasons for that. The biggest one clearly coming in from China, which is reiterating preventing overcapacity in the metal production. Last year, they said that they will not increase capacity more than 45 million tons, and that the markets believe will be hit in 2026. After that, that means China is not going to produce anymore. You already are looking at higher energy costs in sense of Indonesia. Remember, nearly 34% of aluminum cost is energy, and that has been increasing as well. And then there are concerns in Iceland. You have problems coming out in sense of bauxite grades as well, and there is supply concern coming into the street, keeping the aluminum prices on the higher side. Also, there are various reports suggesting that you could be looking at a deficit going forward in sense of aluminum for this year and the next as well. A report from Panmure Liberum says that aluminum market deficit for the current year already stands at 1.8 million tons therein. Europe aluminum demand continues to grow. There is a various report suggesting that consumption for flat-rolled products in sense of aluminum, that consumption could grow at 123% by 2032. So wherever that you look, the inventories, the production, the mining, smelting, consumption, all those numbers tell you that you are looking at higher prices going forward when it comes to aluminum, with the kind of strong demand that we are looking from construction, auto, packaging, even green energy for that matter.
Oh, wow. Okay, so that's bullishness on aluminum. And yesterday we had a JPM expert telling us that the very high copper prices, he's expecting it to go to 12,000 copper, will also have a magnetic impact on aluminum because of replacement uses, he says. So $3,000 was what he was forecasting on aluminum itself. Well, we'll hear more of that. Wrap up on Bazaar on that note. From me and Manisha, thanks for watching. Chartbusters coming up.